Welcome to the Sage Planning Solutions Podcast. Join Brad Marshall, Patrick Bennett, and Dominic Ruiz as we help you navigate life's financial obstacles and find financial freedom. We will cover the major pitfalls that can derail your journey to financial independence. Get ready to learn, grow, and prepare for your best possible financial future.
Welcome to the Sage Planning Solutions Podcast. I'm your host, Dominic Ruiz, and joining me today is my co-host, Patrick Bennett. In today's episode, we'll be exploring the fear of missing out, its potential influence on decision-making, and examining the emotions investors often grapple with. All right, Pat, we're going to jump right into the topic today, fear of missing out. We're both very familiar with that during our careers. Just want to get your input and your opinion in some of the ways that you've helped clients deal with the fear of missing out over your career. We've had an exceptional market. You had a correlation of markets. Everything went to one in 2022. There's really no place to hide other than cash. And then cash was risk adjusted for inflation, still negative. And then you got to pay tax on all interest made. And then you have 2023, which was a phenomenal year. What are some of the things that you've helped clients over your career do to address that concern?
Yeah, good question. I guess I'll start with saying this. Do you remember Steve Irwin, the Australian reptile guy, kind of that wild man? Everybody loved that guy.
Oh, yeah.
So he'd probably been bitten 100 times by snakes over the course of his career. And I think at the end of his life, I think he died due to some sort of snake bite. I guess here's the point that I'm making. We are not immune 100% to FOMO ourselves, right? However, we have talked to so many hundreds and hundreds and hundreds of people that we hear what comes out of their mouth. They are one of one, right? We are the people who observe their behaviors. They only really deal with themselves. If they communicate this to other people, as you know and I know, typically the truth is rarely and purely told. Usually it's a version of the truth. You know, maybe there are some characteristics or flaws or defects that they don't really want to admit of why they did what they did. So it's hard for an average investor to have a real honest conversation with most people. Like if you have a confidant, that's one thing, right? But when they say these things to us, you have to realize it's not necessarily an unvarnished truth. It's going to be sort of a story, right? And people tell themselves stories to sort of cope with the mistakes that they've made. So here's the thing about the snake bite. We've been bitten a lots of snake bites, right? And so we can deal with it a lot more than just about everybody else who doesn't do what we do. However, we're not 100% immune to it ourselves. So FOMO, how do you get over it? You have a plan, you talk it over with your financial advisor, and you stick with it. Typically what we'll do with people, right, Dom, is we'll sit down with somebody and we work for people for free for months and months, quarters, even years sometimes before we really implement our investment strategy with folks. Because if we can't, I guess we're just trust. If we don't have trust in people that they could follow a plan and that they're going to be influenced by the neighbor or by the friend or by what they see on social media, that person, it's very hard to take them seriously because they're saying, well, I have a buddy who didn't lose any money during the market crash. Well, that's not really possible. It doesn't really work that way, right?
I hear that all the time.
Yeah. And if they think that they did, they're probably wrong. Or maybe you heard something that you just really want to hear and you're pressing us to do more. It doesn't truly exist. And then, well, what about this and what about that? Like all these different financial instruments that institutions have access to at a much cheaper scale. It's hard to retroactively go back and do that. So we've been bitten a lot over the years with our own money when it comes to FOMO when you first start off. And then what happens is you build up this immunity because you talk to so many people who are going through it themselves. And you could just very quickly identify, wow, this person their head's not screwed on just right. They're looking at this as a competition, an open competition versus them versus the rest of the world. They're not focusing on what do you want this money to do for you at a certain point in time. You're looking at what's my yield since last week? What's my yield since this morning? And have you ever seen anybody successfully invest that way?
Never. And as you had mentioned, sometimes we work for a while for free, doing all the legwork. I think that having the plan is the most crucial part, and not a financial plan. That's after the fact. I think it starts with one, your ability to commit to a strategy, right?
Mhm.
Most strategies work. It's just the ability for you to be able to commit to that strategy for your time horizon, for it to work. And, the risk tolerance questionnaire, which that's become watered down, but a well thought out one. And you include that in an investment policy statement. Everybody's on the same side of the page, and you really find out their mental capacity in terms of their investment experience with fear of missing out, right? That all leads to loss aversion. So you and I've talked about extensively, when the market's up, everybody's happy. Nobody thinks about a bear market. You do have those that are always looking for a top. Great. And when the market does decline, you could tell somebody, hey, I'm up 10%. Great. I'm down 10%. Oh, well, they feel that 2x is the statistic that they've come up with. They feel the loss twice as much as the gain.
Get on that. That's super important because that's a huge one.
Yeah. Again, you could tell an investor, hey, you're up 10, 15% for the year. And yeah, that's what the market's supposed to do, right? Over time, it's supposed to go up.
That's what the market owes me. That's normal, right?
Exactly. And then the following year, if we go into a bear market, let's take 2022, for instance, it's, oh my God, the strategy I said I was committed to, my investment policy statement, my goals and objectives, they go out the window because I'm scared to lose everything. I feel that the market's going to zero. And the amount that they made in the prior year, the following year, 2022, for instance, their losses, they feel that pain twice as much. And it becomes real. I mean, everybody works very hard for the money. I get that. I totally understand that. But at the same time, it's the ability to commit to that strategy.
Yeah. And so
over time,
on the upside, hey, you're up 12 or 15, it's a shoulder shrug. Okay, that's all right. That's what the market kind of owes me. And then when the market's down that same 12 or 15%, it's, oh my God,
I'm never going to make it back.
Let's be clear on one thing. And I do have some experience in what I'm about to say here is that if there are changes to somebody's time horizon because of a health issue has come up and now we don't reckon time the same way as we used to, or, something comes up which is a direct in conflict to their stated goals, that's one thing, but we have to discuss that, right? That's something we can't just shift on the fly. But if you ask somebody, say, well, okay, I get it. This was hard. However, are you still planning on retiring in 12 to 15 years? Well, yeah. Okay. What are the long-term averages of markets? How many go up and to the left, out of 10 years and how many go down? And you do all that. And people understand that when they are cool-headed, right? When everything's calm, oh, yeah, hey, I got it. No problem. Things go up and down. But there's a certain, I don't know, cadre of people that really should never invest their own money because they just don't have the emotional wherewithal to not drive the car over the cliff.
For example, how many times have you and I met clients that needed a bear market to be, one, to be humbled, two, to realize maybe I need someone that's not emotionally biased and that's going to put me into a strategy that I can commit to because I blew myself up.
You said a tough one there. You said the word humbled, right? And I think a lot of us, we equate humbling with humiliation. You and I, because we're in this industry, we've been humbled. We have been humiliated, but we've been humbled, big time.
Yeah.
And I think anybody who invests and says, hey, I got a great idea, those people have been humbled by the markets because the story was good. The market was good. I can't believe it didn't work out. So those things happen. But we're not teasing people or making fun of people or rolling our eyes at people. It's just we've seen so much of this. We've seen who are the folks that are successful are the ones who you give them a plan, they stick to the plan. When the market's going down, they keep putting money in their 401ks. When the market's going up, they don't all of a sudden decide to buy a boat, right? So we work in Silicon Valley, and a lot of people have concentrated equity positions. It sort of skews the rules. I'm not going to put that in writing, but I'll say it here. It sort of skews the rules because if you say, hey, our net worth is X and now our net worth is X times whatever percentage and it's gone up profoundly, it changes things. And then you have to sit down and you have to take a look at, okay, like what do we really want to do? And to a lot of people's benefit, those are great conversations. To others, it just sort of goes, no, we're just going to kind of keep doing what we're doing. However, we've always wanted that home in Tahoe. Okay, I like taking money out of one financial bucket and putting into another financial bucket. But it's the one to say, we always wanted this luxury car, okay, depreciating asset. We always wanted this boat, massively depreciating asset. We've always wanted this grand vacation, okay, whatever, live your life. But there's ways to pull money out, and there's ways to redeploy it. And then there's ways to just kind of look at it and go, 12 years from now, your kids are going to go into college, and we're going to feel kind of dumb if you bought a boat when you could have put that money and locked up 2 college educations along with postgraduate degrees. And if you never need that money for college because the kids are, stunning athletes or amazing students, great. That's all in your social security number. You're not giving it away.
Yeah, even here in Silicon Valley, as you had mentioned, vast amount of wealth. At the same time, substantial equity concentration from all these companies. Even they suffer from FOMO because, yes, they have an emotional bias with these equity positions. And they've done a really good job over time holding on to those assets. So we know that they have the ability to stick with the strategy. That concentrated wealth has made them wealthy. However, if they have an advisor that they're working with and they have a more of a diversified portfolio, and I'm not talking about over diversification, just diversified. They come up with the strategy, same commitment level. They understand the objective is long-term 15, 20, 30-year growth. The minute the market becomes volatile, they're not worried about that concentrated position.
Mm-hmm.
Then they shift and say, hey, why isn't it going up as much as the market? Why isn't it going up as much as my other accounts? Why is it dropping more? And it just becomes that fear of missing out again. However, with that concentrated position, we know that, again, they have the ability to commit, but they're not worried as much about that as they are as the portfolio where they're working with somebody.
Yeah, I look at those questions, and it's when we go into these areas where we have a lack of control, we want to sort of get into things and dissect them to get answers so we can feel the illusion of control again, right? It's kind of like that Kipling poem, right? They talk about triumph and disaster and treating both those two imposters just the same. A triumph, is it truly really a triumph, or is it just a moment in time? Disaster, is it truly a disaster? Is it really just a moment in time, right? So you're looking at a statement, you're looking at your Schwab, Fidelity, Vanguard, TD, you're looking at all these different things and you're searching for answers. And it's hard because what's more emotional than money? Love, health,
Children.
Family. It's like, what's more emotional than money? And I never blame anybody for when they kind of go a little bit off the deep end in terms of like, I need answers and I need answers now. And as you know, and I know, typically when we have people like that, they're not working with us for a very long time. If they're having a bad day, that's one thing. But if they have consecutive bad days for years on end, we have better things to do with our time than.
That all comes back to the ability to stick to one, a plan, and two, commit to a strategy. If your behaviors are in place and you can stick to that strategy, you do well over a long time, your appetite for risk. So going back to that concept that I mentioned earlier in the episode is loss aversion. So yes, we know that the amount of loss that is realized emotionally is 2x the amount of gain. However, I think FOMO hits both. Whereas fear of missing out, you have the missing out of the up market. So it's like you're losing twice, which I think is a bigger emotion, loss aversion is more impactful than just declining in a bear market because one, you're being left behind. Two, if you made an emotional decision during a bear market, you sold at a lower point, you're not participating in the up run. So it's a double-edged sword. You're experiencing the fear of not participating and the fear of loss at the same time, which I think the magnitude of that emotion is bigger than just the emotion of a decline in value.
Inexplicable decisions are made when fear hits, right? I was talking to somebody some years ago and I said, what's going to happen is you're going to be sitting at a stoplight and you're going to sort of white out. And the stoplight's going to go from red to green and you're not going to budge in the car because you'll be off in la la land until somebody honks and you go, and what were you thinking about? What you were thinking about is, why the hell did I ever get out of the market? And you can't answer the question. Well, I just sort of thought that, and I felt that. There is no right answer. There is no right answer. Say whatever you need to say to that special someone in your life who will listen to you and go, that's okay. Yeah, I get that. Okay, you did what you did. Let's move on. And you could say whatever you want to us, and you can back it with, I was listening to this economist and this one analyst, and this guy on TV and a guy who I know who's really smart, who's made a ton of money in the market. Okay, you did what you did. But at the end of the day, you and I call it attribution analysis. Other people call it like, why the F did I just do what I did? It's very difficult to answer because you really can't put a pin on why did I do what I did? I'm like, I don't know. I felt it in my gut. I would say 1/8, 12.5% of the people, if they say I went with my gut, I'm like, go for it. You're that guy. You're that gal.
Right.
You should do that because you have that ability. Most others, and you and I know a lot, in the bottom quartile who, if you go with your gut, man, you're going to wipe this out. Like you're in trouble if you go with your gut. But, we don't really say that to a lot of people unless we're extremely close with them. And then there's the ones in the middle who, if I'm not a financial advisor right now and I say, hey, Dom, I am going to wherever, I'm done, I'm selling, I'm not doing this alone. I'm going to go pay somebody to keep an eye on me, right? I'm not doing this because with my experience with others' money, that's great. I now get to be an adjunct of their success, okay? But my experience with my money, once the money gets real and that's it, I need someone to help me figure this out. That's why I have an attorney. That's why I have an estate planning attorney. That's why I have a CPA. That's why I pay a bookkeeper. This is why we pay these people money, because I need to be protected from those gut feelings. Oh, and by the way, that 12.5%, trust your gut. I'm not that guy either with my own money. Right. How many times do I call you up? Where am I driving the car off the road here?
All the time.
Where do I have this wrong? Where's my blind spot?
You always need someone to play devil's advocate with your thesis, your gut feeling, whatever you want to call it. You need someone or more people to play devil's advocate, to take the opposite side and ask you and test you. Why is your thesis? Because you should be having one before you put any money anywhere. Where am I incorrect? And are all those facts outweighing the benefits that you're coming up with in your mind, or however you're doing your research? But you need someone to take the other side of your opinion, play devil's advocate, which is you and I talk about all the time, is what am I missing here? What am I not seeing?
The blind spot's a big deal. So the institutions, they call this a channel check, right? I need someone to poke this full of holes because What do? We make an assumption and we start deriving data that supports our assumption. And so now we're kind of we're getting close to delusion.
Confirmation bias. You start looking at things like
support our thesis. We've all done this. I couldn't imagine doing this on my own. I would be terrified to make a decision because we've seen it done wrong so many times by really smart people.
Oh yeah,
right.
Absolutely.
And here's the bigger challenge. And I'm going to say there's smart people and then there's quotes around smart people. When you've had some successes and then you start thinking that you have it all figured out, man, are you a danger to yourself? Once you start believing your own BS, once you start believing, hey, listen, I got a system. Oh boy, a guy with a system. Or you start identifying with different personalities on CNBC or Fox or Bloomberg. It's like you're stuck in the mud, you're spinning your wheel, but you just don't know it. And with some humility, as you brought up before, if you can then look back after time has gone by and really examine, what was I thinking at that time and what did I do? And you realize like, man, I was my own biggest fan. I did this thing because I heard this thing and this guy at the locker room, at the club, on the golf course, at the bar, at the whatever. What a tough place to be, because Neil deGrasse Tyson said this fun. He said it in a great way. It's so dangerous when you know what you know, but you don't know what you don't know. And you have no way of figuring out what is it that I don't know? Because when you're so sure of yourself, your blinders go on to other things. And if new input comes in or new stimulus comes in, you're willing to sort of turn a blind eye to that and go, well, that doesn't really fit in with my calculus on this. So it's a real tough place to be in when markets are going up. How often do you and I pat ourselves on the back anymore when we crush it in the market?
As you know, when the markets are like last year and they're pretty much just going one direction, left to right, up. To be honest, I'm looking for ways of like, okay, well, when I'm going to anticipate volatility, what am I seeing in the technical side of the market? And I'm not going to give myself a pat on the back because, hey, we already know our clients' asset allocation based on their objective. All of our clients that we work with as of today have the ability to stick to a strategy. They're committed. They have an investment policy statement. They're on track. So I don't really get excited during bull markets, right? I'm more concerned with the other side, the risk management side of which.
I'm happy that you're happy, but this ain't going to last forever. There's 3 different phases that when we talk to people, an asset allocation based on what? It's based on your goals, and everybody's is going to be a little bit different. And do you want to talk about the 3 phases of, your accumulation, your preserving, and then your spending? Do you want to talk a little bit about that? Because I think sometimes somebody in their mid 60s says, hey man, I don't want to retire for another 5 or 6 years. So I want to keep investing in the market.
Right.
Okay. Well, are you in that initial, grow it as much as you can over time phase? Or are you in that preservation phase where can you really take a knockout punch right now? And it's hard for people to get out of being the aggressive investor that they've been maybe for 40 years to then ease up, because what's the enemy here? The enemy is, well, we're living too long. It's longevity. So 25 years ago or 20 years ago, we used to look at all the books and it says, Mr. Jones is going to, fall off his bike at the age of 73 and he's done, right? His wife is going to live to 84. And so she needs to have the money around, and all of the capital markets assumptions based on bond allocations and stock allocations, those have now all been completely torn up. Do you want to talk a little bit about that stuff? Because that's going to spin some people's heads. And they're going to go, hold on, I thought bonds were safe.
Well, that all fell apart last 2022.
How much was the bond market down in 22?
The long-term ETF was down, I think, 37%, 38%.
Just so we don't talk over anybody's head, can you deconstruct ETF really quick?
It's an exchange traded fund, very similar to a mutual fund. The only difference is it has daily liquidity, right? You can sell in and out throughout the day, versus at the mutual fund, you can only liquidate it at the end of the market close.
So that ETF, what did it represent? Its holdings were what? Were they speculative high-risk bonds?
Long-term treasuries.
Long-term treasuries.
Long-term treasury.
So the bread and butter of the American treasury, long-term treasuries.
Yeah. And so market declined, everything correlation went to 1. As I had mentioned earlier, the safest place to hide was $1, right? And cash. And even that decreased in value, just adjusted for inflation. So you can have the best asset allocation in the world that you want. But again, I see a lot of over-diversification. That's also a problem in itself too. Over-diversification, they end up being very similar to a risk parity portfolio where you're not going to lose a lot. But
I don't even know what that means. What does risk parity means? You're going to make cash plus 0.5%?
Yeah. I mean, it's more of a risk management strategy than anything else, right? The risk parity, because it's a complex thing. You're taking a bond and you're taking the stock and then you're taking some options. Essentially what you're making is very balanced type portfolio that won't blow up. It's used more for hedging. But all this goes back just to the fear of missing out. I think that if you could stay disciplined, because the fear of missing out, as I said, has a lot of negative effects. But the other side of the coin is if you can just practice being disciplined, right? Maintain a long-term perspective. Very important. If you're working with an advisor, they're going to focus on just bringing you back to your initial conversation. Say, hey, is there something that you didn't tell me? Is there something during a review or strategy meeting, whatever you're calling them? Is there something that I'm missing that you didn't tell me about that changed your objective, that changed your goals? And if there isn't, then you shouldn't be worried too much. Because again, if you have just take the 60-40 portfolio, which everybody talks about, and the market goes up 10, you're probably going to get 6% of that, right? 60%. If it goes down, you'll probably get 60% of that. So it's not so much about performance, but I think that, again, the fear of missing out has people, they don't focus on the bigger picture and they get just an emotional bias, and they leave a lot of money on the table because they make irrational decisions at the wrong time.
Let me ask you something, because maybe somebody listening to this might go, hold on, I thought you said in 2022 the market was great. And now I'm hearing that you're saying that the market was not great. And then you said something about correlations. Can you unwind that a little bit?
Yeah, well, 2022, everything went down, right? Just like during the COVID crash, correlations went to 1. That means even safe investments dropped pretty quickly. However, there was a massive rebound in 2020. 2022, there was really no place to hide. Everything went down, right? Even holding on to a money market account. And the nice thing is, savers got a nice yield on their savings accounts, on their CDs, finally, because we've been in a 40-year or 40-year plus bear market in interest rates. So they got an uptick on their savings. But for 2022 in its entirety, cash was probably one of the safest place to be. But at the same time, your value still decreased because inflation was out of control, and adjusted for inflation, cash lost value as well. So there's really nowhere to hide. So when correlations go to 1, that means everything's bad, especially on the downside. So it ends up being a place where, as you would call it, is the cleanest shirt in a basket of dirty laundry. That was cash last year.
In the finance industry, I don't want to say his name and embarrass him, but he just says, hey, what do you do? Like if you and I go to a barbecue and say, hey, what do you do? I'm a financial advisor. Oh, no one even knows what that means. So I usually keep it vague. I'm in finance, or I say something just so I don't make someone feel like there's some sleazeball trying to get them to talk about their money, right? But it's like, when I think of people in our industry, most of the people that you and I know who have been around, who are survivors, men and women, they are some of the neatest, smartest, most careful people with other people's money. And it doesn't matter what you call them. It just matters what they do. And so like when you and I identify people, we go, man, that guy, he really has a good thing going. Or that gal, she really takes really great care of her clients. It has more to do with them. I guess they deploy empathy to a point, but then they're going to be like, okay, we need to make some changes here. So they have the ability to deliver bad news and also sort of issue tough love, which happens sometimes. And then on the opposite side of that coin, it's, hey, listen, I'm glad you're excited. I'm happy that you're happy. However, let's keep our eye on the ball here. Let's go long-term in our thinking. And those two little actions save people's nest eggs. It saves so much that you can't even believe. It's like I was telling somebody one time, I said, investing's not making 5 or 6 huge steps over the course of your lifetime. And like in the movies where you push the button, buy, and then shortens out. It's not like that. It's how do you make 1,000 tiny good decisions? How do you make 1,000 tiny good decisions? Oh, and by the way, putting money into that 401k that your employer is going to match, that's one of those good decisions. Putting money into that Roth for your kid if you can, that's a great decision. Putting money into a college fund, whether it be a 529 or something else, that's a good decision. And it's doing a whole bunch of things without getting too cute about stuff. The guys who come in from the margins, why are they always guys? They seem like it, are the ones who are trying to sell something that is opaque. It's like looking into the bottom of a black bag. You can't see the sides or the bottoms once it goes down too deep. And if there's a product out there that I can't truly explain to somebody, and I go, you know what? I don't really know exactly how it works, but man, look at all these testimonials. Or, hey, I saw this thing on Twitter, or I saw this thing on Instagram, and there's lots of hand wavy sort of, positive vibe, but there's no real math that can be demonstrated. I think a lot of people get trapped in those things too. Do you have people that have had those types of experiences? I only have a couple, but I certainly have people that call up and go, hey, have you heard about this? And I almost feel kind of like a little embarrassed trying to explain it to them, because I'm like, what you're seeing here is a money-making machine, but not for you.
I've definitely heard about that. And I think it's TikTok is one of the main ones where you have people making recommendations. Like you said, the hand wavy things, little videos. And, they're entertaining, right? By all means, but it's not quantifiable. Great idea, fun, enthusiastic, motivational. Some might think it's inspirational, but it's not quantifiable. If it's not quantifiable, you know me, I'm not even going to entertain it. Otherwise, it's just a waste of my time, because I can't speak in what ifs. It has to be ethical. And again, it has to be something where you can explain to somebody and you have to know like the back of your hand. A lot of these videos that are being made, I don't know how they come up with the information that they come up with, but I also know that they're not regulated.
It's funny. It's like if somebody is on a social media platform offering an investment product to countless hundreds of thousands, let's just say, what is it that you're even selling? You're selling a hope, or you're selling a dream, or you're selling something that you hope baits somebody in. So it's not really consulting. It feels like a form of fraud. I'm not going to go out there and say that because I'm not qualified to make that distinction, but it feels like this is a little greasy. It's a little greasy. And the problem is there's a lot of people out there that they may not know the difference. And if somebody wants to take the counterpoint to what I'm saying right now, they could say, oh, well, you guys, don't do this because you only do it one or another. I can honestly say you and I have looked at just about everything. what have we not looked at? Who have we not gotten on the phone and say, can we talk to your person that builds this so we can understand what it is? My rule is I'm pretty lazy. If you can't explain it to me in 2 minutes, I don't know, man. Or can you explain it to me like you would explain to your mom's best friend? Can you explain it to me like you're explaining it to your grandparents?
That should actually be a rule. I think they're trying to get followers, normal.
What does
Monetize.
followers get them? I hate to even ask that question, but what does followers get them?
It gives them an audience, which who knows, leads to sponsorships and all these other deals.
Gotcha.
Or maybe they're trying to sell some type of courses. Who knows? But, you had to say something about what do people ask you what you do and you say you're a financial advisor. I don't believe in elevator pitches. I think they're kind of cheesy. That's just me.
That's what we were trained to do, right? Back in the 90s. You got to be able to tell somebody what it is that you do. Pop, 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 pop. And it's like,
if I could say anything, I was like, I really want to help people minimize, not avoid, minimize, because it's hard to avoid things when you're starting to help someone or guide someone. Is I would like to help them minimize making impulsive financial decisions, right? I think that can add value if you can guide them and just really look at their portfolio and say, hey, why do you own what you own? Oh, because of X, Y, and Z. Okay. And some of that's fear of missing out. Oh, everybody's doing it, right? I want to do it too. We've all fell victim in some sort of fashion in our life with fear of missing out. We want to be included. And
that goes right back to the schoolyard, man. I mean, that goes back to little child insecurities, and that is deep in our brains to want to keep up and maybe be recognized or maybe win at something. I feel bad for the people who invest in or are trying to win. Oof.
Yeah, you should be focused on winning by, okay, I'm getting closer to my goal. And whatever that is, that's your race. That's not, we're going to work on another segment called Keeping Up with the Joneses. Your friend, colleague, brother, sister, taxi driver, barber, hairstylist, they don't have the same appetite of risk as you do. They don't have the same goals as you do. They don't have the same income as you do. So it would have to be an apples to apples comparison.
I think that's the thing that really gets in my head when you see the TikTok video guys. They're making a massive pitch to one thing. I'm like, you're going to get people in trouble. You're going to get people ruined because you're selling snake oil. I shouldn't say that, but you're selling a dream. And I remember one time I was in a cab and we were in North Carolina and the guy's like, you're involved in the stock market? Yeah, lows up. We're buying houses. We're buying houses. We're flipping houses. And I hope that guy did well. But it's also like when we hear of the non-professional person who all of a sudden becomes a quasi-expert on the subject in a certain market, we go, man, that market's about to get crushed. And it's because not that we know everything, we know we don't. But what we have seen over the past is people that make that one size fits all. You got to be doing this. We're chasing returns. People just get wiped out. And honestly, not everybody really has the aptitude to learn. I think there's a lot of people who are there who are like, I'm just here to kind of get wiped out. I'm here to chase the next big thing.
Yeah, those are the people that have the trader's mentality. One last thing that before we close up shop here is I clearly remember, and this is the best case of FOMO ever. Manhattan, December 2017. I'm taking an Uber and driver asked, it was from downtown to Koreatown, I think it was, going to a restaurant. Yeah. Asked what I do. Okay, I work in finance. And asked my opinion about crypto. And I said, well, I really don't have an opinion. And so I left it at that. He started giving me advice. And I was thinking to myself, okay, well, we're not too far away from a top here. I'm standing in front of the restaurant, waiting for my table, some friends. My phone rings. And then I got someone interested in the same concept. And so I'm thinking to myself, okay, this thing has ripped up so far, so fast.
Is this when was it over 60?
No, this is way before that. This is 2017, before the big crash, which happened literally right after. A client asked me and I said, you know what? Can't participate in that, and a conversation. But it just gave me confirmation that the fear of missing out was kicking in for just your average person.
Yeah. Remember tech stocks in the late 90s, right? Mm-hmm. And somebody, I don't know if it was Westbury or who, but somebody basically said, hey, listen, when you're at a point in a market where every farmer in the Midwest, I don't know why we're picking on them, is cleaning out their bank account and throwing them into tech stocks, it is over, right?
Or not too far.
Well, it's at a point where maybe those people who bought too late are lucky enough to get somebody that's willing to buy it off of them. and it's a tough thing. Now, conversely, and I don't want to pick on any major investment bank, but there will be word on the street is this particular investment bank is now saying that clients should buy gold. They're very bullish on gold. And you look at the chart on gold and you just kind of go, huh, that's interesting.
What are they trying to sell?
They have too much gold. They have too much gold and they want people to kind of go, hey, I heard that such and such is bullish on gold. And that's what they do. And, they can get in front of Congress and they're saying, hey, you're trying to manipulate the market. And they're too smart to get caught. And that's kind of like on the other side of the coin. It's just when like, hey, we have too much of this stuff and we need buyers. And so if there's somebody out there with significant size who actually believes in these market calls anymore. I hear that on TV and I'm like, who even does that stuff anymore? It's so dishonest. Anyway,
It is.
Top of the market, bottom of the market.
Yeah. Well, we're wrapping up today's segment, but if I can leave listeners with some advice, it's really to practice being disciplined, right? Maintain a long-term perspective. Just really try to minimize making impulsive decisions. And if you have a hard time doing that, find somebody, interview a couple of advisors, and get a feel for who they are and how they do things. And if you're going to go with the feeling, let it be that, not about the market. Let it be a feeling about the person that you trust. You understand the process, understand you have synergy together, and then make a decision that way. Don't make a decision based on their credentials only. Make a decision about who you feel you can connect with and that really understand you, your family, and what your goals and objectives are. And that's really all it takes. This one that can guide you through a storm when markets are in disarray and help you throughout any kind of emotional biases that you might be experiencing during fear missing out, bear markets, and even an up market.
I'll add to that. That's really good advice, by the way, Dom. I'll add to that in saying, don't go and start working with the first person that you see when you walk into the bank. It's got to be somebody that you could look eye to eye with. But when you sit down and have a cup of coffee, or hopefully you guys get close enough to break bread, that it's someone who you want working quietly in the background for your benefit over years. When we have those client relationships, we look at how well they do. Because darn, you start caring so much about and you want to see them succeed because you listen to them and they listen to you. You never really hear about the relationship, right? It's always sort of like,
performance driven versus
what's Wall Street selling? Wall Street's selling one thing.
As I had mentioned, based on your appetite for risk, your investment policy statement, the market's going to take care of itself. Get your mind out of focus on solely performance, finding somebody you can trust that has your best intentions for you to succeed and take it from there.
Somebody taking ownership of their own investment policy statement and saying, this is for me, this is mine, and this is how I'm going to do it will save you a lot of tears and a lot of money.
And we should do an episode specifically on investment policy statement, what it is and how it benefits you and how it keeps things transparent for folks.
I like it.
Well, until then, thank you, Pat, for joining me today. And please join us in our next episode, which is going to be Keeping Up with the Joneses.
Thanks for listening to the Sage Planning Solutions podcast. Be sure to subscribe so you don't miss the next episode. If you want more information, visit our website at sageplanningsolutions.com.